Aligning your stop loss with the duration of your trading setup is important. And what I mean by that, for short-term traders, typically 3 to 5 day holds, you probably want a tighter stop, such as half of the day's range. On the flip side of that, longer-term trades, they're going to benefit from stops that are based on moving averages, like a 10-day or 20-day average, just further away from price. Now, support and resistance levels, these are going to play an important role in your placement of your stop. If you can, just set them below support or above resistance, just to protect yourself against any market volatility. But if you're trading a high price stock, these are more known for their predictable behavior. So you can afford a slightly closer stop, and swing trades, probably a broader stop, just to accommodate those intraday fluctuations. So remember, if you use lower time frames for stop loss placement in a swing trade, this will often lead to frustration due to the volatility, and you probably get stopped out a heck of a lot more than you would if you just stuck to the trading time frame. If we're looking intraday, you want to line up your stops with intraday movement. So a clear understanding of your setup is the most important thing for effective stop placement. Now let's talk about volatility. You have to understand how volatile the instrument is. Now we're talking about stocks here. So high volatility stocks, they may need a wider stop just to prevent a premature exit on market noise. You have a low volatility stock, you're going to be able to have a slightly tighter stop because of their relative stability. Now low price stocks, these are the ones that often show high volatility. These can lead to some pretty significant intraday price movements. And if you have a tight stop, probably get stopped out quite a bit. On the flip side of that, high price stocks, these are more linear in movement and more predictable, primarily because of the dominance of institutional trading in them. So that's going to reduce volatility compared to retail trading, the smaller stocks. So just to analyze the historical volatility, that's going to help you determine the appropriate stop loss. Let's talk about position sizing. This is a critical element of risk. As an example, allocating 2% of your capital to each long-term position, well, this can help limit potential losses. In a worst case scenario, if one position were to go to zero, the maximum loss to your overall portfolio is 2%. But if all 50 positions, for example, were to lose their entire value of 2%, well, that total portfolio loss would be 100. This strategy emphasizes the importance of diversification and position sizing in managing your risk. Now, a hybrid approach, this combines position size limits with absolute stops, like setting a stop at 10% below the entry point. Well, that can further mitigate your risk. Now, this strategy is often used more in quantitative trading. This helps to effectively manage your losses. Now, many traders, especially beginners, struggle with effective stop management due to just a lack of clarity in their trading setup. When you do not align your stop strategy with your trading time frame or your strategy, this is going to lead to unnecessary stop outs. At the same time, when you use a tight stop without considering the volatility of the instrument, that's a problem, and it's a common issue. Frequent stop outs, these cause frustration. We all know it, but it really emphasizes the importance of understanding the stock type or the futures or whatever it is being traded. Having a clear trading setup improves your stop effectiveness, but just make sure you regularly review your past trades. This is going to give you some really important insight into any stop management issues you have, and it's going to help you adapt your strategy to align with your trading stop. And never forget this, always educating yourself on the behavior of your instrument, and the volatility is key. That's how you improve your decision making over time. It doesn't take long just to flip through a bunch of charts and just to see what the prices are doing. Let's discuss structural stops and setups. So structural stops, this involves placing stops below a recent consolidation low, for example. So following a breakout, a stop might be placed below the consolidation box. Your stop is then adjusted as new consolidations start to form after the breakout. This is more designed for longer term holding strategies, okay? It's going to require strict criteria for the instrument selection just to ensure there's some potential for growth in the instrument. Trading flat things, not going to be very helpful to you. When you have a clear setup, it dictates appropriate stop strategies for different instruments. Strategies for high-priced stocks may differ from those for low-priced stocks. When you have a well-defined setup, you know exactly what your setup is. It's going to improve your position management. It's going to simplify the entire process of managing your stop. So just make sure you know your setup inside and out. Mastering the art of stops, it is absolutely essential for protecting your capital and achieving success. When you align your stop with your trading setup, when you consider volatility, when you manage your position size, and you avoid the mistakes everyone makes, and you understand what a structural stop is, now you can significantly improve your trading outcomes. Just test it. Keep learning, stay disciplined.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.